This is the second of a two-part market update this week for SD Bullion subscribers. It's completely free, so if you like it, subscribe. Of all the bullish headlines, record precious metal ETF fund flows, bullion shortage premium gap outs, and price action this past week, perhaps one of the more important headlines and articles was published by a former longtime Financial Times, now Bloomberg columnist named John Authers. Earlier this week, John wrote the following headline in a mainstream financial media. If you've bothered to look of late, the incredible data and facts building within the precious metals arena make this seemingly hyperbolic headline actually seem tame and grounded. So we are going to dig into some of his points regarding record gold and silver bullishness building. And following that, we'll dip into some more record-breaking data updated from today. As well, we'll review a few other financial insiders' takes over the years, men who have warned us along the way that these days were coming. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button below, help me hijack this algorithm so we can serve more people this precious information, or just share it directly with someone you love. Back to John Authers, financial insider who would never be allowed to publish a headline like this without his editorial gatekeeper's approval. Article headline reads, "A mighty short squeeze may be building in gold. An increase in demand for physical deliveries could trigger a parabolic rise and cause problems for banks." Silver and gold. There's plenty of talk about a bubble and some new companies with untried business models. Think particularly of Tesla Inc. But is there something equally unsustainable going on in a commodity whose virtues have been known for millennia and remain unchanged? Spot gold rose to a record of $1,923.20 an ounce in Asian trading Monday. This is the third major spike in the modern era since the Bretton Woods tie of the dollar to gold was abandoned in 1971. Once inflation is accounted for, gold remains below the last all-time high of 2011 and far below the historic summit of 1980 in the wake of the second oil price shock, when investors assumed that endemic inflation would continue forever. That 1980 rally bore all the classic signs of a speculative excess, and was born of the common but often mistaken tendency to extrapolate well-established trends into the future. Gold at that price would have made sense if double-figure price inflation had continued indefinitely, but it didn't. We need to bear this in mind when looking at current projections. It certainly looks from the charts as though gold is bound for the unprecedented level of $2,000 per ounce. Real yields on Treasury bonds are in historic downtrend, and they overlap closely with the gold price. When bond yields are negative, gold's lack of income ceases to be a problem. The dollar is also weakening against a range of currencies. Amid speculation, the time for prolonged downward wave has arrived. The problem is that it is easy to over-extrapolate these trends. The relationship with real yields is undeniable, but having touched their all-time low from 2012 last week, can they possibly go much lower? Long-term Treasury yields have been flat at around 0.6% for 4 months, behaving as though the Federal Reserve is holding them there. The decline in real yields has come from a return to more normal levels of inflation expectations. There are reasons to brace for higher inflation. In the short term, the pandemic's impact has been more deflationary. Can we really expect the Fed to keep nominal yields capped even as long-term inflation expectations take off? That is implicitly what bullishness on real yields and gold implies. And there are plenty of ways it could go wrong. So is gold falling victim to speculative excess? One counter-argument comes from Michael Husch of Deutsche Bank AG. He points out that the price increase hasn't been particularly swift or disorderly, and the greatest interest coming from central banks and particularly from exchange-traded funds. The GLD ETF now has a market cap of $75 billion, having grown at more than twice the rate of gold price over the last 5 years. Meanwhile, speculative position in futures suggests the market is less overblown than it was earlier this year. This certainly doesn't look like speculative excess that could lead to an imminent crash. More intriguingly, the rise in trading in financial gold, without taking physical delivery of any bars or coins, might bring with it the seeds of a big rise. The theory, which gets technical, is explained here. The issue, in short, is that far more investors are opting to take physical delivery when contracts end, rather than roll them over. This from Longview Economics shows the number of contracts that are being converted into physical deliveries. Gold futures are a handy way to hedge financial risks, but they've never been used to buy bullion on this scale before. As the next chart from Longview Economics shows, The same trend is at work for silver, although it isn't as extreme. Why is this happening? This behavior is coming particularly from the group labeled Other Reportable in Commitment of Traders Disclosures, which includes family offices and high net worth individuals. Worried about protecting the value of their fortunes, they're opting for the perceived safety of physical gold. This creates a specific problem for swap dealers, which are run by the bullion banks and make a market in gold. At present, as the following chart shows, they are very short gold, meaning they need the price to decline. If gold doesn't fall and investors ask for physical delivery, the risk is that they will have to buy bullion they don't yet have. Longview calculates that the bullion banks have a short position worth $39 billion at current prices, the highest since records began in 2006. The concern is that we'll see something like an old-fashioned bank run, or the remarkable event in the oil price which saw the West Texas Intermediate go negative earlier this year. That was caused by an excess supply of physical oil. In the gold market, the fear is of insufficient supply. As Longview puts it, bank runs occur when lots of depositors demand their money back at the same time. The bank, of course, doesn't keep all their money in the bank. Deposits are lent out as loans, and so on. As such, banks suffer short squeezes of liquidity if too many depositors ask for their money at the same time, unless and until the central banks step in with newly created liquidity. Just like in a bank run, therefore, if too many gold future holders decide to take delivery of physical gold at the same time, rather than simply rolling their contracts, then it's likely the swap dealers won't be able to satisfy all those demands, i.e. the physical gold isn't there/available. It's with that backdrop that we wonder if the other reportables, investors/speculators, are deliberately or just coincidentally trying to create that situation, akin to how hedge funds/other investors exploited the lack of storage capacity at Cushing, helping to push the oil futures contracts into negative territory in April. If so, then this will be one of those rare occasions when the message of the positioning, sentiment, and other models is wrong, and markets don't immediately mean revert, but enter into one of their occasional parabolic price moves. The gold price sends valuable signals that other markets take seriously. If a golden bank run does come to pass, there will be ramifications far beyond the market for bullion. A dramatic spike beyond 2,000 would grab attention, arouse deeper fears about inflation, and test the confidence of central banks to keep rates low. It could also pose serious problems for banks and maybe even spark another bailout dilemma. The rally may not yet be excessive, but in the futures market lies the risk that it could become so. So as promised, a few warnings from the past. We shall begin with famed American hedge fund manager Kyle Bass, who in 2011, the last time gold was nominally priced near the levels it is today, he had the following to say on why, as a then acting member on the board of directors at the University of Texas and Texas A&M Investment Management Company, UTIMCO, an endowment fund for Texas public universities, why back then he strongly suggested the endowment increase its holdings of gold to $1 billion and also take physical delivery of the investment in the form of gold bullion bars, shunning both COMEX futures contract rollovers and any major gold ETF like GLD or IEU, which of course charge management fees, and 2, regard their shareholders as unsecured creditors who have no ownership to any of the gold bullion supposedly held within the trust ongoing. Here's Mr. Bass nearly 1 decade ago.
Kyle, can you talk a little bit about gold? Why at UTIMCO you actually took delivery of the actual gold?
So I'll give you my opinion. I won't speak on behalf of UTIMCO.
Sure.
So my opinion is very simple. As a fiduciary, which I am in that position, to the extent that you own gold and you are going to own it for a long time, it's not a trade, it costs us about 90 basis points a year to roll it through financial futures contracts. And then we went and looked at the COMEX. So the COMEX at the time had about $80 billion of open interest between futures and futures options. And in the warehouse, they had 2.7 billion of deliverables. So 80 billion of open interest, 2.7 billion of deliverables. We're going to own it a long time. You're on the board. You're a fiduciary. What do you do? Like, that's an easy one. You go get it. All right. So you go take $1 billion of the 2.7 billion and let them worry about the rest. Mm-hmm. And when I talked to the head of deliveries for COMEX and IMEX, I said, well, what if like 4% of the people want delivery? And he says, oh, Kyle, that never happens. you know, we rarely ever get a 1% delivery. So, and I said, well, what if it does happen? And he says, well, price will solve everything. I said, thanks, give me the gold. You know? And then what was interesting was we conducted an audit of the delivery. And what was interesting in the audit was they kind of resisted our audit request on the front end. And then they finally allowed us in. And we did a random audit there of, we had like 1,600 bars or something like that. And we just wanted to see 20 or 30 of them. And they were all over the place in different venues in the vault. They weren't segregated. So yeah, it's an interesting concept. But what I'm saying is the exchange is a fractional reserve exchange, and they think price will solve everything. So I mean, that was a decision. It's actually an easy decision if you're a fiduciary.
Quickly, let's briefly swing back to this long-term CPI gold chart that John Authors used in his article, the one that we started this market update with. It's the same CPI chart that we'll undoubtedly get beaten over the head with further as the years come along. And it's, of course, dumbed down CPI, or government-generated consumer price index, a fiat Fed note fool's tool when trying to understand value over long times, looking backwards. You see, the government's been rigging this index since 1980, the last time gold called the full fiat financial system to account for its up-to-then debasement. I suppose the government realized then that battling inflation was partly psychological warfare. The U.S. government has had a real motive for underreporting inflation data over the last 4 decades. You see, we pay out promises, like a Ponzi with the printing press, ones that we never save for, but based on supposed inflation rates we claim are accurate, and therefore we pay for less than what we probably should. Things like Social Security, government pensions, and other unfunded liabilities, which now measure in the hundreds of trillions of dollars. Never mind, we've been rigging and hedonically adjusting the data for 4 decades compounding. John Williams of Shadow Government Statistics still uses the old 1980 methodology for measuring ongoing inflation, and his chart here shows gold as still being cheap, considering all the collective inflationary lies we've been telling ourselves over the decades, all while technological productivity gains have masked much of the misinformation. Perhaps the inflationary truth of this all lies somewhere in between, but having lived the last 4 decades, I'd venture to guess that John's chart here is closer to the truth than the government's CP lies ongoing. As mentioned, more record data was made today in the COMEX gold futures contract market. Apparently, more family offices and high net worth other reportables have again decided to stand for delivery and stop contracts at new record size levels. Here are a few charts putting this into historic perspective. Nick Lard, the owner of the website goldchartsrus.com, had the following insights. He stated, "To put today's first day of delivery contracts into perspective, 32,732 contracts equals 3,273,200 ounces, 101 metric tons, which is the equivalent of the sum total of all deliveries for 2019. 2/3 of the supply came from the bank prop trading desks, and 50% of the demand came from the bank prop trading desks." And while the last few years of gold performance has been very good, we look both ahead and backwards, listening to the words and warnings of the still CEO of CME Group's COMEX NYMEX, the same gold, silver, platinum, and palladium futures market that's critical to the world's ongoing price discovery for these precious metals. Terry Duffy had the following to say on Fox Business News in July 2017, 3 summers ago.
We have seen that through this period of uncertain times or uncertain times within the Fed.
But we haven't seen it into the metals. We haven't seen this if you're concerned about, for example, global crises. And we see a little bit when we see the, a dust up with the North Koreans or all of it. There's a brief run up, then it runs down. But what do you think is going on there, or beneath the scene? Is there something that we're missing?
Well, I think that's really interesting that, what you raised, especially with the metals, because if you look at the price of gold today, just around $1,200 an ounce. And if you look at back in the early 80s, it was trading around $800 an ounce. So if you adjust for inflation, you should have gold somewhere around $2,000 to $3,000 an ounce, but we don't. And then you look at what's gone on in the world, and it should probably be at $5,000 or $6,000 an ounce, but it's not. So the reason is, I think a lot of us have become so jaded, and whatever happens in the world, it's like yesterday's newspaper in 5 minutes. So people are dismissing some of these events to a point where one day you won't be able to dismiss them, and you'll see a huge move in some of these precious metals and other products.
I know you and I are sounding like the Cocoon Club here, but I think a lot of young investors, they don't remember that a lot of this stuff.
No.
That historically we have, resisted of late, but you haven't resisted, the simple fact that markets do go up and they do adjust and they obviously do change.
That is all for the second of two-part news-heavy market update for this Precious Metals Week. Stay tuned for next week, and until then, all the very best to you and yours. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.